We think the floor is coming out, and it could be sudden, where we could see the dollar go from 108 plus now to 106 to suddenly it's at 100, and it occurred within a matter of a couple of months. When it snaps, that's when you'll see gold snap the other way, and I think that's what gold is watching primarily right now.
Hello, I'm Noah, the original prepper. Perhaps you've heard of my ark. Well, if you would like to be prepared, check out these 1 ounce silver Noah's Ark coins from Armenia. Right now, only $4.25 over spot. And if you get 500 of them, they come in an amazing wooden monster box. Can you believe it? We also have the 1/4 ounce Noah's Ark coins with the same beautiful design, 1/4 the size, at only $3.25 over melt.
1 ounce silver 2022 Noah's Ark coins at $4.25 over spot. 1/4 ounce silver 2022 Noah's Ark coins, $3.25 each over melt. Call 1-888-81-LIBERTY. 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Be back, Elijah.
It's great to have you. And you just told me off air that you have a big story, earth-shaking, it sounds like.
It's not covered that much, except that, the dollar's strong. Okay. There was an article in the Wall Street Journal yesterday. I suggest everybody get it. It's in the business section, lower half of the business section of the Wall Street Journal. An article about emerging markets and how they're being stressed, some to the point of near collapse financially by the strong dollar. You have to realize that in Europe and in lesser countries around the world, strong dollar is hurting them in terms of their ability to buy essential foods, energy, and so forth. It's going up for them because their currencies are going down relative to the dollar. The Fed likes to act like they're looking at all the data points that are domestic. Okay, so their job is to protect one, restrain inflation here, but two, the other side of the equation is to protect the unemployment situation. But they casually dismiss that as, we've got no problem there. Okay, well, if you look at the unemployment and the employment numbers and find out who's being hired where, you'll see it really is in sort of the the leisure industry is where a lot of the hiring is occurring. And those numbers, by the way, can change drastically and quickly, like a light switch. So anybody who assumes you look at the data from last month and you've got a reality check, no, you don't. Okay. First off, we know that Europe is probably in a recession. They're being choked by high energy prices to the point of where they have to shut down, cities at certain points in time of the night, and factories are cutting back in production. And China's now admitting very bad economic numbers. And if their government's admitting bad economic numbers, you can bet the numbers are worse than what they're admitting. Okay, so you have two of the major economies in the world, Europe and China, let's call it in recession or beginning to enter recession. It's argued that Europe's already in one, period. Bank of America claims that the U.S. is already in the second quarter of recession anyway, despite what the government claims. And, a sober outlook there from them. And also from JP Morgan. They've come out with highly negative comments about what's coming. But the Fed's all happy. They're going to curtail inflation and so forth. The problem is the Forex issue, because it is choking Europe in terms of the cost of what their euro can buy in terms of energy and so forth, which the comparisons are stark versus us. If they go into recession and China goes into recession, we're going too. You can chatter all you want to about a good-looking unemployment number. Or listen to Biden talk about how things are looking rosy and it's the best in decades. We'll go down real quick. We're not going to be isolated. So anybody who thinks that you just look at our data points is making a mistake. But this dollar issue is far more acute for some emerging market countries, including some major emerging market countries. And I suggest you read that article in the journal. I'm not going to go into it here except to say that it did point out a feature that we have technical reason to assume is the next major pivotal explosion point in the marketplaces. That's the dollar. And when I say explosion, I mean implosion. Back in 1987, before I ever established momentum structural analysis, I was a futures broker from 1975 to 1992. As it happened, I caught the crash in 87, and I caught it because I was running quarterly momentum of the S&P 500, meaning I'd run every monthly bar and plot it in relationship to its three-quarter moving average on an oscillator, not just overlaying it on a price chart. You look at the price chart, you had this upward trending market. Naturally, all bull markets look that way. But on a momentum chart, you had a floor. It was being repeatedly hit and hit and hit. They kept buying it at a certain level relative to that three-quarter average. So I saw a structure that said, oh my gosh, when momentum builds a structure that is so obvious as that, it's like when a price chart builds a structure that becomes so obvious that everybody can see it. Well, that doesn't matter so much as when momentum does it. Because momentum builds a structure, it's going to use it. It's not there to ultimately be used as repeated support forever. It's going to break that support. The more it's used, that structure, the riper that structure is for an implosion, for something more and more dramatic, the more times it used it. The dollar index, which is largely, we know, 57% euro and 17% yen, so it's largely those two currencies. But when I technically analyze the dollar index on a quarterly basis, or versus a three-quarter moving average, or versus a 3-month moving average, which is like an intermediate trend metric, both of those momentum charts jump off the page at me and say, you're going to break down. And when you do, you're breaking a structure that is enormous. In fact, on the monthly oscillator, we've spent I think we're now into the 14th month of living above the 3-month average. It doesn't inhale. I mean, it inhales only, it won't exhale. Markets normally breathe. The dollar index has lived on this floor, and it's developed, therefore, a momentum structure. And when you go back down and you tap that structure again, I would bet on the dollar imploding rapidly. Now, there's a reason why the central banks probably, or the Fed might like to see some kind of pullback in the dollar occur, because they are jeopardizing the fiscal and financial status of a lot of these significant developed economies, emerging economies, and it also hurting Europe badly in terms of their ability to buy energy. So though they never discuss the issue, Powell never mentions the dollar. He did not today. It really is an issue in the back office, because I have no doubt that the central bank heads of Japan, Europe, and the US have been on the phone about that issue. And there's some point where that dollar is a killer, because it's going to help drive those economies into a recession and worse if it doesn't stop. Now, because of the investor excess and sentiment, and I don't just mean common day investors, I'm talking about corporations, countries that have committed to the obvious trend of the strong dollar, 20-year highs. Actually, if you stand back and look at 50 years of data, it's pretty unimpressive. The 20-year highs is from a very shallow range. But anyway, the point being that it is choking a lot of economies, and therefore it is an issue that the central banks will have to address. Recall back in 1998 where the Thai baht currency collapsed. Also, the Russian ruble had some problem. Here Thailand, okay? The market collapsed in 1998. They had to come in and bail out one of the largest hedge funds in the world. The Fed had to effectively buy it. If you recall, Greenspan was in charge then. That was just the Thai baht. What happens with Egypt and with some of these other larger developing economies that are, again, read that article, that are being stressed badly? What we're dealing with here are central banks that could go under, large banks that could go under, and make headlines that would suddenly hit a light switch that people aren't even thinking about right now. So our focus is on the dollar index right now, and I think that's one of the reasons why gold is not collapsing. Yes, gold is weak today, but remember, it's been in a 2-year range with lows 3 times in the 1670s, highs above 2000. We recently got back to that low, and we didn't break it. Somebody bought it again, drove it up to 1800. Right now we're trading about 1750. How come gold's not collapsing? How come it's down on the year 5-6% with the S&P's down, double digit? Everything's down double digit, especially today. And gold is not falling apart. I think gold knows that, if you look at a chart of gold versus the euro, gold versus other currencies, it's very strong. Against the dollar is the only one where you've got this range. And I think the dollar gold understands. There's some investors in gold understand that there's this problem out here about the dollar that can't be allowed to persist, because if it does, it'll collapse so many things. Therefore, some kind of policy change has to occur. Maybe it's behind back closed doors, but something has to occur in terms of causing this excessive investor flood into the dollar, which has been overdone, technically speaking. And whenever you get a market that gets overdone one way, usually when it snaps, it goes farther the other way than it might otherwise. So I think the focus right now for investors should be the dollar index. Right now it's trading in the high 108s. It's been over 109. Our metrics say that starting next month, just 4 or 5 trading days from now, you get down around 106, it's over. Now today's low is like 107.50. Okay. So, a couple points below where you're trading right now in the dollar index next month. And we argue, and we provide specific numbers in our reports to our subscribers. But basically down around that level, we think the floor is coming out. And it could be sudden, where we could see the dollar go from 108 plus now to 106 to suddenly it's at 100. And it occurred within a matter of a couple of months. A very dramatic situation, in part because the crisis situation has been built up fundamentally, and secondly, because of the excess investor and corporation and government trend assumptions about the dollar, that they've gotten excessive, and when it snaps, that's when you'll see gold snap the other way. And I think that's what gold is watching primarily right now. So anyway, that's my big thought.
No, I mean, that's definitely very, I guess, encouraging for the people who are looking at the precious metal sector right now. So you're looking at this pretty much being the bottom for precious metals and just slingshotting higher once the dollar starts to break.
Well, we were open to the possibility. Of course, everybody was expecting, by the way, that last drop we had in gold, a month or two ago, we got down to under 1,700 again for the third time. And yet somebody or somebodies, and I think it was large hedge funds around the world, bought into gold there. They just bought the weakness. They said, we've got to have gold. They knew it was doing better than any other asset on the planet this year. It still is. And they had to move to something that's performing better. Even if it's down, it's performing better. And I think they gobbled it up. And sure enough, boom, we bounced again. I don't know if you're going to get another chance to break that level, to go down there in the high 1600s and drop to, like everybody was expecting, gold's going to 1200 or something like that. Why? Because they measured the thickness of the range we've been in, subtracted it, the great science, They had their opportunity and they blew it. How come? How come gold didn't collapse? So I think the sell-off we're getting right now, based on, again, the Fed today, everything's selling off, gold to a lesser extent than the stock market. If this doesn't take hold and you see gold next month, again, in a handful of days, push back up toward 1,800, I would then circle that last third low and say that was definitely it. We've already had enough intermediate trend momentum metrics that have shifted to positive already. There's a couple more we'd like to see shift, including the silver versus gold spread, and we think it will. But, so it's not like there's one number we won't cross, but we've seen enough evidence already to indicate that probably was the third and final attempt to break gold, and it didn't succeed. And therefore, now the issue is, okay, what's going to engage you on the upside? And I think the two factors. One, get gold back up around 1,800 again during next month. Get silver over 20 again next month. And watch that dollar index. And I think those three combined could create a vacuum-like effect move in all three of those markets. Sharp down dollar, sharp up gold and silver. So anyway, we're waiting on that. We're monitoring, and we have specific numbers. But that's the thing that's most on my mind right now is I sleep with them. The charts, the quarterly chart of the dollar and the monthly chart of the dollar momentum indicate to me this is a market that's topping and ready to go down sharply.
Do you see what the Fed might be doing to be triggering any of this? Because, I mean, we are seeing the Jackson Hole meeting right now as we speak. And if Powell speaks and then the stock market is down, the Dow, 600 points. So your perspective on that?
Well, I think that the stock market going down, they've ignored it to this point because we've come down in an arm wrestling manner. We got bearish on the NASDAQ 100 at the January close and on the S&P at the February close, well above current levels. About 5 weeks ago, we called for a rally from 3,800s. We thought we'd go to 4,100, but we viewed it as a, quote, bear market rally, so treat it as a trading event, not a trend reversal event. It actually got up to 4,300. And then last week at the mid 4,200s, we said exit. Bear market rally's over. Likely we're going to trend back down again. Okay, we seem to be doing that. There are some levels well above the June lows. June low was under 3,700 S&P, and we had projected earlier in the year that likely we'd get a good bounce point around there. And on the NASDAQ 100, we projected likely a good bounce point at 11,000. It stopped at 11,037 and produced its rally. So we got the bounce we expected as a bear market rally. We think that rally's over. You do not have to go all the way back to the June low to take them out. To take them out in price, but momentum has certain levels credibly above the June lows that if we hit them, and we'll specify them in our reports, we think the June lows are gone. That's when you could get a speedier decline in the stock market. And that's when the central bank will get a little more upset about the stock market. So far, it's been, like we said, arm wrestling decline, which is the way most bear markets behave in the stock market. They don't crash. It's highly unusual. But we think we could speed up the process if you go back down again and hit our secondary trigger numbers, that you're going to take out the June lows, in which case you're going to get something pretty sharp. Not necessarily a crash, but something enough that would jolt the central bank and also further cause changes in the unemployment numbers. Because you got to remember, corporate executives, CEOs, they don't just look at their own internal data. They look at their assumptions about the economy. And if that stock market goes through those June lows, you're going to have a lot of hiring managers told to put a freeze on that or to even cut back. So we already know that's occurring in a lot of industries. Hasn't hit the unemployment data yet. I suspect it's going to start hitting. That's when the Fed's going to have to pay attention to their other mandate and where it suddenly becomes important. I also suspect that, as I said, behind the scenes, this dollar issue has been a discussion between the central banks. Almost guarantee it. They haven't talked about it publicly. But one way for them to sort of obviate that is for a sense of narrowing between our extreme tightness policy and the ECB's less tightness policy, to where they either get a little tighter or we get a little less tight, or we indicate, as he did today, maybe this 3/4 might be it for a while in terms of increase and so forth. He likes to sound threatening, but there's equivocation in there. And I'm sure if he gets any data points, like a shift in the unemployment stuff or the stock market breaking the June low, for example, they're going to have to soften up. And as soon as that occurs, that's going to cause a lot of sentiment change in the dollar against the euro and the yen, in which case the excess that's been built into that dollar upside could quickly reverse. So it's a backdoor issue for the Fed and the ECB. They're not going to talk about it publicly, but I'm sure it's an issue.
And as for leverage here, do you think that the mining stocks will do best when this all turns?
They invariably do. And I think they'll come out of a slingshot hole. Yes, they're underperforming gold. They always do. When gold goes down, they go down more. When gold goes up, they go up more. Okay, that's just a general rule. And I'm talking percentage dynamics. The same is true with silver. And one metric we're watching there very closely, in fact, we're watching it week by bloody week, is the silver-gold spread. There are some numbers not far above where the spread is right now that would tell us that the spread is shifting toward favoring silver. And when we see that breakout on momentum of that spread, not the spread itself, we're measuring it on a momentum chart. There's a ceiling on a 10-week average oscillator of the silver-gold spread. Sounds kind of obtuse or obscure there. But there's a ceiling structure on that goes back like a year and a half, where every time you get the momentum readings up to a given level, they crest. So you've created a structure, a ceiling, and it's shallow. So it won't take much if that spread upticks just a little bit from where it is now. And again, we measure Friday closes versus Friday closes of gold versus silver. Silver is going to break out on momentum. And every time it does that, it usually leads to not just an outperformance of silver versus gold going forward, but an actual net price increase in both metals, with silver at the forefront. So that's another metric we're watching very closely in terms of defining the definite upturn in the metals. Not merely that they're holding some given level like gold has, but they're actually going to turn up and make a move through the highs. And we need that silver gold spread to break out, and I think it's likely to do so. It's just a matter of which week in the coming weeks will it signal that for us, and we let our subscribers know.
And speaking of that, the website is olivermsa.com. Michael, before we let you go, if you could share with our viewers once again kind of the key things to be looking at right now. It sounds like at the forefront should be the U.S. dollar.
Yeah, I think it's suddenly, because of its technicals, its momentum technicals, I see the potential for what I saw in 1987 with the S&P, which was a momentum floor that if you were to look at the momentum chart of the S&P back then, you would have been very excited about the potential for downside. You look at the price chart, you couldn't quite define it. I see that potential now on the dollar, where it would very easily snap its uptrend and go excessively the other way, thereby wiping out all the built-in assumptions that it has accumulated over the last year about, it's going to go up forever type of thing. That could reverse quickly, and I think if it's going to happen, I suspect it's going to happen soon, like in the next month or so.
All right, and remind our viewers where they can go to subscribe to your newsletter.
Well, olivermsa.com. MSA stands for Momentum Structural Analysis. And you go there and you can see an explanation of our methodology, some sample reports, and request some samples. Send us an email and be happy to send you some recent sample reports. And thanks for your attention.
Yeah, well, thank you so much, Michael. You're one of our viewers' favorite guests, so we really do appreciate your experience and insights here. Once again, thank you so much for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.